Welcome to this Killick Explains Finance video. This week, going to take a look, seems like the right time of year, at 3 things investors should remember about risk as we head into 2020. So, with no more ado, what are those 3 things? In a nutshell, there are many different types. Now, that sounds like a platitude, but it's important to remember when you say, I am worried about risk, that you really understand what it is you're worried about. Number 2, you can't avoid it altogether. It is simply impossible to rule out all risk from investing, just as it is impossible to rule out all risk from life in general. And thirdly, absolute tolerance for risk is personal, but the factors that underpin the relative risk you should take are not. So that's basically hinting at 2 different types of risk, what I call absolute risk, also known as market risk, and then relative risk. And it's important to be clear on the distinction and important to be clear on how you're going to manage the 2 things. Alright, so categories of risk. I said there's more than one type of risk. Well, the main one, just a reminder, I've mentioned this before, is price risk. People think the danger when you invest in things like equities is they go down rather than up. And sometimes, historically, they've gone down rather suddenly and sharply rather than up. But, and this should be reflected in the price arguably, and there's a key point there, liquidity risk is also important. If you need to get your money back, could you do it without taking a beating on price? And there's counterparty risk. What is the danger? That actually I never get my money back unless there's a compensation scheme in place because my counterparty disappears, goes bust, fails to pay. Now, the levels of these risks vary considerably depending on the asset class you're talking about and the individual securities within that asset class. But nonetheless, just be aware that in financial markets, there is more than one type of risk. And in theory, you should be paying a price that reflects the whole picture. Now, types of price risk. So let's drill down a little bit further because price risk is the one that people are worried about as we go into 2020. People thinking, we've had a relatively long period of stock market growth, 10 years, let's say, what could happen next? Well, absolute risk is the idea the market could drop. Now, we've seen some big falls all the way through from the 1970s, early 1970s, where the market dropped 2/3 in less than the space of a year. It is possible. So big falls, that's market risk. Now, the point I'm going to make is that is not something you necessarily need to worry about unless you've got the wrong approach. Then there's relative risk. That is the level you accept for the chance of making a higher return. What I mean by that is that stocks, all other things being equal, should give you a higher long-term return than bonds. You accept more risk in return. Both of those will generally return more than cash. You accept a bit more risk in return for extra returns, if you want to see it that way. And neither should be a big problem for a long-term investor. So this is the point. They're different types of risk and they both need managing. But one thing you shouldn't do is try to avoid them both. That is a classic mistake. So the risk myth, as I call it, is what? Well, we're all exposed to risk all the time. As someone quipped, no one gets out of here alive, talking about life in general. So there is no point in saying I'm going to totally de-risk my portfolio. There is no risk-free investment path. Why not? Because people are thinking, well, surely I could just take all my money out of the markets, park it in cash and wait for better times or bigger opportunities. But the point is cash is risky. It all depends what you mean by risk. Essentially, if you are losing money in real purchasing power terms over time, you're taking a risk, even if you think you are smugly and happily sat on a mountain of cash. And I've used this before, but there's a chart that makes the point. If you're wondering what this is showing, it's saying, well, way back in the early 1970s, I mentioned that enormous bear market in stocks, and there it is. Had you put a sum of money to work, the amount's less important than the way the lines go, what would have happened next in real purchasing power, that's ability to buy stuff terms? And you can see that what is in fact £25,000, quite a large sum of money, put to work in cash using data from Barclays would have been reduced to around £1,800. In other words, the purchasing power has been annihilated. It literally buys a lot less than it used to, whereas had you followed a basket of UK stocks put together by Barclays, as I mentioned, you would have seen an increase, a considerable increase in your purchasing power. Now, you'll notice something else about the lines. This one's fairly smooth. You're losing purchasing power over time in a fairly unscary way, if you want to see it that way, whereas this one is pretty wobbly, suggesting that, yes, in order to get that increase in purchasing power, you might be accepting some short-term volatility. But that's the point. The point I'm trying to make is the pink line there, showing that cash is not a risk-free place for money. Now, relative risk. I mentioned this before. I'm going to just wrap up a few points on this now. We all have different risk tolerances. This is the point. My risk tolerance is not the same as yours in terms of the personal risk I'm prepared to take, the business risk I'm prepared to take, and the investing risk I'm prepared to take. That's why some people are entrepreneurs and other people work in the civil service or tucked away at the HMRC offices, for example. Nothing wrong with those jobs, it's just they're a very different risk profile. The result can be over-caution or over-optimism. And this is the problem. You can actually think, well, I've got my own personal risk tolerance and I'm sticking to it, but it might result in you being a little bit too cautious over the long term. We've got to increase our purchasing power, or, of course, far too optimistic. Depends who you are. And certain factors will change how we should all manage risk. So I'm going to finish on this idea of relative risk and the idea that you can actually assess your own ability to take risk incorrectly in one sense. So, universal factors. Age, that does matter. When you are 2, if someone's investing on your behalf, they should be taking a lot more risk than somebody who's investing at 72. And they might be taking a lot less than someone who's investing at 42. So age does matter, but it's not the only factor. Right? It's not to say that the moment you pass 50 or 60, you should de-risk everything. Certainly not. Health is another factor. If you are looking at, for example, should I buy an annuity with my money or should I do something else, you've got to weigh up the possibility, unfortunately, that if you are in poor health, you won't get the income stream for very long, so there might be a better path that you could use that money for. Relative wealth. Now, what I mean by that is when you look at a pool of money and you're thinking about risk, is this your nest egg? Is this all you have? And that might affect your approach to how it's invested, or is it one part of a bigger picture, a bigger empire? Maybe you've got other assets. If you're looking at an equity portfolio, maybe you've got properties, for example. Maybe you've got some other way of generating income. In other words, you may be cushioned, and that will affect your view of the amount of money that you're looking at investing. Objectives. What is it for? Is this money that you might need tomorrow? Is it money that's to pay for something in 7 or 8 years? Or is it money that actually is your long-term family wealth that might even be passed on through future generations? That's going to affect your attitude to where it's invested and the sort of returns you try to expect from it. And finally, market awareness and experience. This is an important one. There is no point, especially out there by yourself, investing in something you don't really understand, you don't understand the risks of. So the degree to which you understand the market and how it works and what you're being asked to buy or have decided to buy yourself is clearly important. That's important in any field of life, and finance is certainly one of them. So there you have it. 3 things to remember about risk as we go into 2020. Who knows what 2020 will bring? I don't have a crystal ball, but with the right approach, I don't need one could argue. Editor@killick.com with questions. If you'd like to see videos related to this one, killick.com/learn. Pop down the tabs here and investing principles. It's quite a good place to start.